Hey, it's Delay, and this is episode 201 of the Orange Pill Investor. And this is the first time I have recorded the entire frickin' episode. Somehow I had two audio inputs and it was there was an echo. It was like the sound of my voice times two, just off enough to just be completely unlistenable. So, today I want to talk about the difference between selling options and buy and hodl. And I kind of think about being an active trader and selling options as trying to win. And the philosophy of buy and hold is more like just trying not to lose. And that's not necessarily a dig if somebody, has a real job or whatever and they DCA into a position and, you know, they love their job and they they get fulfillment out of it. I'm a little bit jealous because I am actively looking to unask myself from my job and support myself completely trading next year. But yeah, if I did something I loved, I would probably do that as well. I'd just take some extra money and put it into positions, and then over time it would grow or whatever. Um, a lot of us do that with Bitcoin, and plenty of people do that, especially with passive strategies, index funds, and whatnot. However, if I'm just going to support myself trading in the stock market, then I've got to make some money with the money. And for me, selling a covered call makes sense. And it takes a little bit of a risk to plant your feet in the ground and say, I will accept this much money for the risk of the price going above 135. Or I will accept less money for the risk of it going over 140. And then hopefully the price will appreciate and I'll be able to keep the premium. And since I'm so bullish on MicroStrategy, I'm actually reinvesting all of the profits. But somebody asked me how, when I am limiting my upside and I'm choosing how to keep enough uncovered potential so that my shares don't get called away, even selling these fairly dangerous at the money covered calls, this is how I do it. I do a little bit of a thought experiment. And when the price was 140, uh, a 10% up move would be, basically going up $14. But to make the math easy, let's say the price would go up to 155, and then 20% would be going up to like 170. And so if there was like a 40% move or let's just say almost 50% move, and the price went up $60 a share from 140 to 200, let's just make the math easy. Let's say it goes to 203 because now I've got to come up with $60 per contract times 21 contracts. So 60 bucks times 21 contracts is 1260, but this is options we're talking about. So I would have to, if if MicroStrategy goes to 203, I got to come up with $126,000 to roll these 21 covered calls. And so let's see how many shares I would have to keep on hand uncovered. I haven't kept any uncovered. But to prevent all of these from getting called away, if I actually wanted to pay to roll, the new share price would be 203. So if I divide that by 203, I'd have to have 620 shares uncovered, which would be like 300-ish per 100, excuse me, per 1,000 shares. And I think last time I was thinking that a reasonable amount was probably like 20 delta per 100. And so this kind of works because this is a pretty extreme scenario. But buying 600 shares is way more expensive than just buying long calls. So these 20 long calls right here is over 600 delta. And this price is what, halfway between 19 and 21. So 20 bucks. That actually works out nicely. So these are about 2 grand a pop. And to get this 600 delta here, I need 20 of them. So 20 times 20 is 400 times 100 is 40 grand. So instead of paying 130 a share for 600 shares and costing me, what was this, 126, well, I'm sorry, at current prices. So 620 shares times, it was 143 at the time. So it cost me 80, 90 grand to buy 600 shares, but it only cost me 40 to get the same amount of delta to cover my upside. So buying these long calls is much more cost effective. Now the trade-off is that, granted, they're leveraged to the upside, which is why I'm buying them, but they're also leveraged to the downside. So worst case scenario is if MicroStrategy drops to 100 again, which is not unreasonable actually, because we've got it testing 100 twice since May. We tested 100 here, we tested 100 here. We have pretty legit support here. Now the good news is I think 100 is probably the low for this cycle. Going forward, but if it cracks materially below 100, we're probably looking at 80. I'm not a big technical analysis guy, but it does seem like you'll have historical resistance that becomes future support. So like we cleared this, boom, 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 everybody's happy. But then if we crack 100, it's probably going to 80. I'll probably hit, this will probably be the new support here. So that would be ugly. And if the price of MicroStrategy does drop 25% down to 100, these long call positions would probably drop by 50%. It would be ugly. So this is very risky to do, way more risky than just buying the shares. But for me, as bullish as I am on MicroStrategy and it's not financial advice, I want to buy the cheapest delta that I can find. I want to control as much positive MicroStrategy delta for as little price. So every time I sell covered calls against my shares, which are, I almost said they're not leveraged, but this is a margin account, so they're technically leveraged as well. I am using that premium then to buy leveraged delta. And the beauty of this is that if the price of MicroStrategy does launch to 200 in a week, this 300 delta will also increase. So right now it's only controlling about 30 cents on the dollar. But as the price of MicroStrategy increases, I will actually get more value from this. I already talked about the flip side. If MicroStrategy crashes, I these positions will absolutely get wrecked. So, bit of a risk there, but and I don't want people to think that this is all the risk that I'm taking, like this buying power is all the dry powder there is. Um, if MicroStrategy just crashed in half, or like let's say it did go to that 80, this would absolutely lead to a margin call. I have no illusions that these um these covered calls here would protect me that much to the downside. So I would have to probably like get money off of my home equity loan of line of credit in order to cover something like that. Um, this might be the last thing I talk about on today's video, but I still have these loser put credit spreads here. These are pre-split, so that's why I have 10 of them. But it looked like I might win them when the price of MicroStrategy was flirting with 150. I thought, oh man, if it clears 150, these will all turn into winners. But as it stands, I will probably take the full losses on these. So while that I think every bullish strategy is a winning strategy for MicroStrategy over the next year or so, you should still expect to lose sometimes. The number don't always go up. Sometimes number go down. Now these that I sold for the September 20th expiration, I had about 20 something days left on these. I sold them for like 30, bought them back for 15, pocketed the $15 per contract. So made about 150 bucks here, 10 times 15. But I will probably take max losses here. And if I can, I will probably try to close these before expiration. Some people just say, oh, just let them expire, worthless, no problem. They will, whoever bought your put will exercise that bad boy on you. And then to protect you, your exchange will exercise the put that you bought. And then you'll just be out the $100 a share per contract. While that is true, there's some weird shit that can happen with defined risk spreads. So the way that I just said it is that's what's supposed to happen. They exercise on you, your exchange exercises for your protection, and then you just have to make up the difference, which since my strikes are $1 apart, I would lose $100 per contract times 10. So my defined risk should be $1,000 total, but I also got paid like $30 a contract here. So really it's like 600 bucks. However, weird thing that has happened to people, if the buyer of my put, because let's say that the price collapses and the buyer of my put exercises, like maybe the price goes down to 140, they make me buy the shares at 150. They can go out on the market and get them for 140. They make a tidy little profit. So then to prevent me from getting screwed, my exchange exercises my put and I get to buy them. Actually, I might have these reversed. But exercises my put, and then I'm actually going to make someone buy my shares at my strike price. Well, the weird thing that can happen is the person who exercised on me can reverse that decision. So now I'm on the hook to buy their shares at the market price. But my exchange doesn't know or doesn't alert me and reverse my exercised option. So now not only do uh, I've exercised my position, so I'm forcing them to buy my shares at this strike price, but now I've got to go out to the market and buy them. And if the price of MicroStrategy has reversed suddenly after hours on Friday, and now the price is like 160 a share, now I'm on the hook to go out and actually buy them at a higher market price so that I can sell them to this guy cheaper. People have gotten completely wrecked by defined risk trades in the past, and that's how it can happen. So if you get exercised on, and then your exchange exercises to protect you, and then the other party reverses their exercise and basically unexercises it. Um, if the price moves against you, you can get screwed. So I could have said all of that with fewer words if I only had more time. But long story short, I will probably try to close these if it's even remotely close on Friday. Otherwise, I can just let these. I can normally just let these expire. Um, I've had some weird things happen over the weekend, like on some of these spreads where it looks like they've exercised one of them, but not the other. And my account was like negative $500,000 or something. And then on Monday, I just about shit myself. But then on Monday, when everything kind of canceled each other out, and my exercised options caught up with their exercised options, it all worked out and it was fine. But it was an uncomfortable weekend staring at an account that had negative hundreds of thousands of dollars in it. Um, yeah, I don't know if sell in May and go away is a real thing, but it would have worked so far. What did we have? This was March, but like May, we had a 170. If you sold at 170, come back in September, October. I don't know what it's going to be, but you could definitely bought some of these dips, which is another reason why I don't mind limited upside, because I was forced to sell 100 shares at 170. I had the 170 strikes. I had 300 shares. I let 100 of them get called away at 170, and then I used that money to pay to roll the other two covered calls. So I think I paid like 30 grand for one and 25 for the other, something like that. So I ended up taking some profits at 170. So that kind of worked out. I mean, if I had dry powder, that should have let me accumulate some more positions down here cheaper. Um, so that's why I kind of think of selling covered calls as like buy low, sell high for dummies. It's just kind of easy mode. You let the strikes just determine whether you're going to sell those shares or not. Um, I fully intend not to let my shares get called away. Not before maybe October next year. A lot of people have been talking about October. I think a bunch of people have the December 2025 long calls and are expecting to manage these like 2 months early. So that is a little scary that everyone is thinking the same thing. It's like, okay, who's going to, you know, jump out of the market first and leave everybody else holding the bag? That's going to be interesting to see how this plays out. Um, and I am kind of flirting with just being as long as possible come late September, early October, in case we get some kind of late end of the year push. Um, but for the next month at least, I will be aggressively selling covered calls and buying as many leveraged long positions as I can get my hands on. Not financial advice. Position sizing is everybody says everything is the most important element of stock market trading, but position size probably is the most important because it determines whether you get completely blown up or not. And if you're completely wiped out and get a margin call, then you're out of the game. So, position size, if you never have a position that can completely destroy you, then you'll never be completely out of the game and you can, claw your way back to profitability. Right after position sizing, I would probably say is liquidity, which is why I stopped trading HUT because the options, the bid ask spreads, just on a small option like this should not be more than 5-10 cents max. And this is like a 20 cent bid ask spread. So I liked HUT, but it's not really working out. All right. So that's how I figure out how much uncovered long exposure to keep to protect these shares. And but it's impossible to fully protect them. The only way to fully protect them is to not sell a covered call in the first place. Because at some point, if MicroStrategy goes to 250 or 300 or 400 or 500 or whatever, at some point, these couldn't keep up anymore. And I would be forced to let some of these shares get called away. But I think 50%, a 50% rally in 1 week, I think is a reasonable worst case scenario to protect against. And I've got that much delta just in these long calls. So not even including any of these. Yeah. So I hope that sheds some light on how I think about how much unlimited upside I think is necessary when limiting my upside with covered calls. So that's it for now. Be good, y'all.